Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our lesson on statements of cash flows, IAS 7, by taking a practical question and then trying to understand from the practice. And so without wasting much time, I would want to go straight to the question and then let us solve it together. But remember to subscribe to the channel if you are new, share this video, and let others also have a benefit. I know that we shall be successful as we continue to follow Fog Accountancy Tutorials. Okay, so let's look at the question together. The draft final account of Receivable Limited for the year ended 31st December 2021 are as follows. So we have the statement of comprehensive income for the year ended 31st December 2021. We have the turnover to be 306,500. We have cost of sales and then gross profit to be 46,500. Then we have the general, administrative, and selling expenses as 14,000, giving us an operating profit of 32,500 Ghana cedis. And then we have investment income of 5,000 Ghana cedis. And then net profit on ordinary activities before interest and tax, 37,500. And then we have interest expense to be 4,000. So when we take that out, we have net profit after tax. Net profit before tax, 33,500 Ghana cedis. We have taxation to be 3,000. When we take out tax, we have net profit on ordinary activities after tax to be 30,500. And then there is an extraordinary item, which is the net insurance proceeds from flood disaster settlement, 1,800. Giving us a net profit transferred to income surplus of 32,300. Okay, so we proceed to the income surplus account for the year ended 31st December 2021. We have the balance brought forward to be 13,800 Ghana cedis. And then the net profit for the year that is to be added is 32,300. And then we pay out dividend of 12,000, giving us a closing balance of 34,100 on the income surplus account. Then finally, we look at the statement of financial position. So like I told you, the statement of financial position has been given to us in a 2-year comparative way. So we've been given the statement of financial position for 2020 and then for 2021 so that we can compare and then use them to prepare the statement of cash flows. Okay, so with a comparative statement of financial position for non-current assets, we have investments. It's 25,000 for both years. Remember that the opening year rather is on the extreme right. So we have the PPE at cost for the current year to be 37,300 and then the previous year to be 19,100. Accumulated depreciation on PPE is in brackets, 10,600. So that is it for the non-current assets. And then we come to the current assets. With the current assets, we have cash to be 100 and then 250 respectively. We have short-term investments, 37,000, 1,350, 1,350. And then we have accounts receivables to be 19,300 and 12,000. And then we have inventory to be 10,000 and 19,500. Okay, so that is it for the current assets, giving us a total assets. Then we go to the equity and liabilities portion. Under shareholders' equity, we have stated capital for both years, income surplus. You could see that the stated capital has increased from 12,500 to 15,000. Let us pay attention to that because we are going to use that in our analysis. Then we look at the income surplus also, which has gone up, which is interpreted by the account. And then we have the liabilities. Under the non-current liabilities or the long-term liabilities, we have the long-term debt, which has also increased from 10,400 to 14,900. And then we have the finance lease obligation, which is 8,100 for only the current year. Then we have our total liabilities. So total equity and liabilities is the same as the total assets. Then we look at the additional information. 1. During the year, the company acquired some new items of PPE, of which items costing 9,000 Ghana cedi was acquired on finance lease. An item of PPE which had cost 800 Ghana cedis was disposed of for cash carrying value of 200 Ghana cedis. That is the first one. 2. Accounts receivable at the end of the year included 1,000 of interest receivable. During the year, interest income received amounted to 2,000. Investment income consists of interest income and dividend income. And then the final one. The board of directors were not satisfied with the draft account for 2021 on grounds that in spite of the profits after tax of 32,300 Ghana cedis, the cash position has worsened by 150. They suspect embezzlement of cash on the part of the financial director. Required. As a financial accountant, you are required to prepare a detailed statement of cash flows in a manner prescribed by IAS 7 to explain the situation to the investigator who has been detailed from a serious fraud office and to allay the fears and suspicions of the directors. So this is our question. We are supposed to prepare a statement of cash flows according to IAS 7. And that is what we are going to do. And so I have just given you an overview of the question. I'm going to solve this with you, and I'm going to take my time and explain some of the things that I didn't explain in the part 1 of this video. And then we are going to solve this question together and then see how best we can help and understand it. Okay. So looking at this question, I've told you that whenever you get a question on cash flow, before you begin even solving the question, you should be able to establish the difference, the movement, the net increase or decrease in the cash and cash equivalents from the comparative statement of financial position that you have been given. You should be able to determine that. Then afterwards, I will tell you some important things that you must do as well. Okay, so let us try and establish that. So let us do some workings before we solve the question. So the first one that I will do is even to compare with you. Let's look for the opening cash and cash equivalent, and then we take it out from the closing cash and cash equivalent. So from the beginning, we could see that the cash and cash equivalents that we have in this question is the cash and then the short-term investment, as we can see from the statement of financial position. And so let us look at the opening balances. The opening cash balance is 250, and then the opening short-term investment balance is 1,350. So that is going to give us a total of 1,600. So we can say that opening cash and cash equivalent is 1,600. As we can see, 1,600. And then the closing cash and cash equivalent is the cash balance here is 100, and then the short-term investments is 3,700. So the closing cash and cash equivalent is also 3,800. So that is going to give us 2,200 as the difference, and that is what we call the net increase, because we started with 1,600 Ghana cedis, and then we are ending the year with 2,200. So this is a net increase. So in other words, for all the cash flow statements that we are going to prepare, we are supposed to get a net increase of 2,200 in cash and cash equivalents. That is the meaning. And then having understood this, let me also tell you something. Now in the part 1 of this video, I spent a lot of time to talk about the operating activities. I didn't spend too much time on the financing and then investing activities. Now, with the investing activities, one of the most important things that are usually hidden from the question that you have to find it yourself is the cash that you parted to acquire a new asset. Okay, you always have to test that whether you bought a new asset or you didn't buy a new asset. And then with the financing activities, I also made it clear to you that with the issue of shares, you can look at the opening balance of your share capital and the closing balance of the share capital, and then you compare. If there is an increase in the share capital, then obviously it's as a result to issue of shares. Okay, so those are some of the things that you should pay attention to. Looking at our non-current assets from the statement of financial position, we could see that at the beginning we have at cost. Okay, they also show the accumulated depreciation, but at cost, let's focus on the cost component. We have 19,100 at cost from the beginning, and then at the end of the year we have 37,300. That shows that there has been an increase in the cost of the property, plant, and equipment. And what we should understand is that when there is an increase in cost, it's two things. It's either we bought them or we went for finance lease. These are the two obvious things. It's either you bought or there was an increase that you bought, because if there is any revaluation upward, it will be mentioned in the question. And once there is no mention of revaluation, then there are only two options that we are left with. Either we bought all the difference as we parted as a new purchase, which it means that it has a cash effect on the business because we buy with cash. Remember, we are using the indirect method, and then we assume some of these things to be payments of cash directly. But except we are told it's a finance lease. But if we are not told, we always assume that we paid with cash. And then we are told in the additional information, first one, that during the year. So whenever we are solving any question of this nature, we usually begin from the additional information to try and do our workings before we start the actual cash flows. So from the additional information, the first one says, during the year, the company acquired new items of property, plant, and equipment, of which items costing 9,000 was acquired on finance lease. So let's pause there. Let us first of all find the difference between 19,100 and 37,300. We can see that the difference is 18,200. If you compare 37,900 and then 19,100, the difference, 37,300, 19,100, the difference will be 18,200. So if you compare the asset value at the beginning, non-current asset, PPE at the beginning, and then PPE at the end, you could see that we are focusing only on the PPE because the investments are the same. So at the beginning of the year, you had your property, plant, and equipment value to be 19,100. And then at the end of the year, you have the value to be 37,300. There has been an increase in the property, plant, and equipment value by 18,200. And that is what I'm saying, that if nothing is said about the increase, then we take all this increase as a purchase of a new asset. And a purchase of a new asset means that it is a cash outflow. That is, so we are going to take this figure as a cash outflow under investing activity, because I have told you that when you are buying a new non-current asset, it's an investing activity. However, we are told that 9,000 was acquired on a finance lease. So it means that with this 18,000, 9,000 out of the 18,000 is on finance lease. And we know that when we are acquiring assets by a finance lease, we have not bought the assets outrightly. Okay, so we cannot call this whole 18,200 as a purchase of a new asset. All right, so when we take that out, then it means that we'll be left with 9,200. Then we can say that this 9,200 is sure that we have bought a new asset by 9,200. But we are not done. Let us continue to read. We are told that an item of PPE which had cost 800 was disposed of for a cash carrying value of 200. Now, let us take note. I'm not interested in how much it was sold. We are told it was sold for 200. So that one is proceed, it's a cash inflow. So let us hold on with that. That one has been given. Let us focus on the disposal. We are told that the asset that was sold had a cost of 800, original cost. So it means that this closing balance of 37,300 that we see on the question, if not for the sale, would have gone up by an extra 800, because at the beginning, this 19,100, the 800 that has been sold, the cost of the asset of 800 which has been sold, is inside the opening balance, because at the beginning it was there. But at the end of the year, it's not part of the closing balance because we have sold it out. So if it had not been sold, then it means that that value would have been there. In order to be able to get the true value of the amount that you used to buy the PPE, you need to factor that 800 as if it was not sold, because if it was not sold, let's assume that if it was not sold, it would have been 800 plus this 37,300. That will tell you the actual amount that you have used to buy a new asset. Don't be deceived. I don't know if you understand what I'm trying to say. What I'm trying to explain is that we have, even though we have a closing balance of 37,300, this closing balance of 37,300 excludes the cost of the asset that was sold. But in the opening balance, it's inclusive. So what it means is that if you want to know the actual increase in your PP, you need to factor that 800 as if it was not sold, so that you'll be able to know the true value. So if this asset was not sold, then the true value of the asset would have gone up by 800, and that will tell us how much actually we have used to buy a new asset. And so we are going to present this in a proper way, okay, by trying to find out the difference between the two assets. Not because we are going to say that the 800 has not been sold, no, but we want to know the true value of the addition that we made within the year, okay. And so let us look at this. We are saying that this working, I'm going to call it cash used for purchase of PPE. So that is what we are going to find. We are going to find the amount of cash that we use to buy the property, plant, and equipment. And I'm going to begin with the closing balance of PPE. The closing balance of PPE is 37,300 Ghana cedis. And then we are going to add back the cost of disposal as if it was not sold. So 800. So if this 800 is added back, we are going to have 38,100. So it means that if not for the sale of this asset, this should have been the closing balance. And that will help us to know the addition we made within the year. And then we are going to less the opening balance and then the finance lease. So we less the opening balance of PP. And the opening balance of PP, according to the question, is 19,100. So if you are taking this out, it should have given you the difference, okay? Then we are told that we also took some of the asset through finance lease at a value of 9,000. So these two were already there. Okay, so we had 19,100 already there. We added a finance lease. So it should have been 28,100. That is the difference. Okay, so now we know that if you add the opening balance to how much you acquired through a finance lease, it should give you a total of 28,100. So why is our closing balance not 28,100? Then the difference means that we bought some new assets by cash, and that is going to be 10,000. So ladies and gentlemen, when we are preparing the statement of cash flows and we get to the financing activity, we are going to pick 10,000 Ghana cedis as the value for purchasing, or the cash that was used for buying a new PP. Let me tell you one thing. When it comes to statement of cash flows, this working that I have just done is one of the most difficult that a lot of students face. Okay, because normally they are not stated directly in the question. And when you are calculating the cost for purchasing PP or the cash that is used to purchase the property, plant, and equipment, ignore every depreciation effect. That is why I have ignored every depreciation effect. Don't come and say, what about the depreciation and all that? No, please ignore every depreciation effect. As long as you are looking for the cost that was used to buy the PPE, you only focus on the cost component of the PPE. And that is why when I was adding back, I only added back the cost of the assets. So let me tell you the general principle is that, one, it is your opening balance. It is your closing balance plus any cost of asset disposed minus any opening balance. Or if there is any finance lease, you subtract that as well. This is a simple approach that you can use for every cash flow question that you have in order to arrive at the cost that was, in order to arrive at the amount that was used to buy an asset. Except you are told in the question that there was a revaluation upward, in which case you need to look for the difference. If there was an upward revaluation of 3,000, then you need to subtract that upward revaluation of 3,000, and that will have given you 7,000 as the cash that was used to buy a new asset. But once there is no revaluation, this is the simple way of getting the cash that was used to buy a new property, plant, and equipment item. I know it's getting understandable for you now. Okay. And then before we begin, we know that we have to also find our depreciation. Now, in some questions, depreciation will be given to you. But in this question, there was no depreciation given. It doesn't mean there will not be depreciation. Depreciation has been treated as part of administrative, selling, and distribution expenses, okay, which we can't see. But we have been given an information in the statement of financial position. We've been given the opening balance for accumulated depreciation, and we've been given the closing balance for accumulated depreciation. So the opening balance is 10,600. The closing balance is 14,500. So when we look at the difference, we can just say that there has been an increase in depreciation from the opening to the closing, and that difference is the annual depreciation for the year, as simple as ABC. This can be that simple only when there was no disposal. But in this question, there was disposal. So we have to look for the accumulated depreciation on the asset disposed because it has already been subtracted from the closing balance. So we need to add it back, the accumulated depreciation of the asset disposed, just like we added back the cost of the asset disposed. So let me tell you this. When you are looking for the cost of the asset bought, you add back the cost of the asset disposed to the closing balance. In the same way, when you want to find your annual depreciation for the year, you add back the accumulated depreciation of the asset disposed to the closing balance. And so let us try and look for working three and call it annual depreciation charge. So my annual depreciation charge will be closing accumulated depreciation. My closing accumulated depreciation from the question is 14,500 Ghana cedis. And then I'll add back the accumulated depreciation of the asset I sold. Now the question is, how do I know the accumulated depreciation of the asset I sold? Let us go back to additional information. 1. We are told that an item of PPE that cost 800 was disposed of for a cash carrying value of 200. Now take note. What is the carrying value of the asset? It's 200, and then it was costing 800. So if an asset was bought at a cost of 800 and had a carrying amount of 200, the difference of 600 will be the accumulated depreciation over time. Now let me also add something very important to you. We are told that it was sold for a cash carrying value of 200. So the 200 is actually the cash that we have received from the sale, but it was exactly the carrying amount. So in other words, there was no profit nor loss on the disposal of the asset, just the break even. But as for the accumulated depreciation, we've been able to establish that it's 600, which I'm going to add. But I want to explain something important to you. That assuming that the asset was sold for, let's say, 300, okay, and then in the question you saw a profit on sale of the asset of 100, okay, then it means that you can use that mechanism to determine your accumulated depreciation. Let me explain it to you. You bought asset for a cost of 800, then you sold it for 300. Then you are told you made a profit of 100. So if you take the profit out of the sales figure, it means you should have sold it for 200. This should have been the actual value of the asset. That is why you are getting a profit of 100. So if you compare, you can still get your 600 as your accumulated depreciation. But because in this question there is no profit on disposal of assets, then we are also told specifically that it was sold as a cash carrying value of 200, and that is why I am saying that there is the accumulated depreciation is 600 straight away. So some of these things can be dynamic, so we just have to be smart in some of our dealings. And before we will be able to understand some of these workings very well, we need to understand the standard IAS 16, property, plant, and equipment. We need to understand it very well, because when it comes to statement of cash flows, even though I spent a lot of time on the operating activity, the movement in working capital and all that, when it comes to the financing activity, that is where the technical workings are. Okay, it's all about the PPE, but we need to understand the IAS 16 very well before we'll be able to do some of this. So we add back the accumulated depreciation. So depreciation on disposal So the assets was depreciated by 600, and that is going to give us 15,100. So it means that if the asset was not sold, our accumulated depreciation at the end should have been 15,100. And then we can now subtract the opening balance of the depreciation, opening accumulated depreciation. So accumulated depreciation at the opening per the question was 10,600. So when I put that in bracket, it's going to give me 4,500. So when I subtract, it means that for this year, the annual depreciation charge, which was included in the selling, administrative, and selling and distribution expenses, is 4,500 Ghana cedis. That is the meaning. This is the depreciation. So look at what we have to go through to find our depreciation charge, and what we have to go through to find the money that was used in buying a new asset within the year. So you need to master this very well. You need to look at it. You can reverse this video and then take a look at it again. That if your depreciation figure is not given, these are some of the ways, or this is the way that you have to go in order to get your depreciation charge for the year. Okay. And then let us look at the next additional information. Account receivable at the end of the year included 1,000 Ghana cedis of interest receivable. Then he says during the year, interest income received amounted to 2,000 Ghana cedis. Investment income consists of interest income and dividend income. Wow, this is interesting. So we are told this, that the account receivable at the end of the year, if you look at the question, account receivable at the end of the year is 19,300. And we are told it includes interest receivable of 1,000. You know, when we talk about account receivable, it could be trade receivable and other receivables. Now, remember that when we are doing the working capital changes, we compare the opening balance of trade receivables to the closing balance to get the movement in receivables. But we are told that over here, even though the closing balance is 19,300, inclusive is interest receivable of 1,000, which should not be part of our working capital movement adjustment. So what we are going to do is that we have to take that 1,000 out, because it is for interest receivable, before we find our movement in accounts receivable. So let me just do a slight working here for that. So I will say that working for account, or let me just do movement in account receivable. So there is the balance at the end is 19,300, and then we are told that the inclusive is interest receivable, so we should take it out. So less interest receivable. It's not supposed to be there in our movement of trade receivables. So we have 18,300. This 18,300 is what we need to compare with. We need to compare with the opening balance, and the opening balance is 12,000 for account receivables. So balance at the beginning, or balance at start, is 12,000 Ghana cedis. So when we compare, we have 6,300 as our movement in trade receivable. So this one shouldn't have been workings, okay? I told you that when we get to working capital movement, we just compare. But this person wanted to add an extra trick by including interest receivable, which is not supposed to be there. So we just take that out, giving us the true value of the closing balance of the trade receivable. And when you compare, you have 6,300 as your movement in receivable. And because it's an increase, okay, we know that when your receivables are increasing, then it means that you have, it's a cash outflow. That is the meaning. It's a cash outflow. So we are going to work on that. Okay. So that is for the receivable. And I'm doing the working for that because they are in the additional information. And then let's continue reading the same additional information. During the year, interest income received amounted to 2,000. Now, interest income receivable is 1,000. When we say receivable, it means that the people are still owing us. They are supposed to pay. So it is like, that is why it was part of account receivables. So we are supposed to receive interest of 1,000 which has not come. But we are told that the actual interest that we have received is 2,000. So the question is how much was our interest income for the year that we have earned? If you have received 2,000 and you are still supposed to receive 1,000 more as a receivable, if you add the two, then that means that we have actually earned 3,000, but we have only received 2,000 out of it. That is the meaning. So it is what we have received that we need in the statement of cash flows. We don't care about what is yet to be received as far as the cash flow is concerned. But we are not done. Let us look for one more thing. We are told that investment income consists of interest income and dividend income. So where is the investment income? They have not told us, but let's go back to the income statement. In the income statement or the statement of comprehensive income, after operating profit, we have investment income of 5,000 Ghana cedis. Now, this investment income of 5,000 is what we are told that it has two components. Interest income is one component and dividend income is another component. So we are supposed to split the 5,000 into interest income component and then the dividend, but we are told it's investment income. So let us do that splitting. So investment income, working 5. Investment income. Now we are told that it consists of the dividend income and then interest income. But as for the interest income, we don't know what amount should be for dividend income, but we know we have received 2,000 interest income and then we are also supposed to receive 1,000 more. So the balance per question is 5,000. That is for investment income. We are told that interest income received is 2,000 and then interest income receivable is 1,000. So these two alone gives us 3,000. So it means that out of the 5,000 investment income, 3,000 relates to interest. So the difference of 2,000 will be for dividend income. That is the meaning, because we are told that this 5,000 consists of two things: interest income and dividend income. We don't know anything about the dividend income, but what we know is that we have received interest income of 2,000 and we are still having 1,000 more to receive. So when you add the two, according to the accrual concept, we need what we have earned, and we have actually earned the two, which is the 3,000. So if you take 3,000 out of 5,000, you have 2,000. That will be the portion for dividend income, and that one is also received. So this is how you go about that additional information as well. So remember, as you continue to read the additional information, you have to do your workings as and when it's needed. And then finally, let us look at the last additional information. Okay. The board of directors were not satisfied with the draft account of 2011 on the grounds that in spite of the profit after tax of 32,300, the cash position has worsened by 150. We can see that the cash position was 250 from the beginning and 100 from the end. Okay. They suspect embezzlement on the part of the financial director. So we are not going to do any actual workings with the last information. It's just to psych you up for the requirement. As a financial accountant, you are required to prepare a detailed statement of cash flows in a manner prescribed by IAS 7 to explain the situation. So we are going to prepare statements of cash flows using the indirect method. That is what we are going to do now. So these are the workings. As we continue, if there is anything that I have to draw your attention to, I'll quickly do that. And then I want you to follow and pay attention carefully as I go on to solve this question with you. I may clean these workings, but at least you should have these figures down somewhere as we continue, because I'm going to use them all. Okay, so let me just do a quick recap of what we have done so far. This one is just the opening and closing balance of cash and cash equivalent to give us a net increase of 2,200, and it's the ultimate. It means that for all that we are going to do, we are working towards 2,200. If you don't get 2,200 at the end, then we have done something not right. Then this 10,000 is the cash that is being used to purchase a new property, plant, and equipment within the year. And this 4,500 is a depreciation expense in the income statement, which was used in calculating profit. And therefore, we need to add it back to the operating profit. And then this 6,300 is a movement in trade receivable. And then we have investment income, which has been split into interest income and then dividend income. But you see, when we get to the statement of cash flows, we are not going to pick the 3,000 for interest income. No, only 2,000 has been received, and that is what we need. But as for the dividend income, it has been received because there is no accrual statement mentioned over here. So we are going to pick these 2,000 and the other 2,000 as investment income, one for dividend and one for interest income received. And the receivable, we are done with it. It's not coming because we are dealing with statement of cash flows. So I'm going to clean the board and then continue with the main work. Okay, so we are going to prepare the statement of cash flow for Receivable Limited. Receivable Limited. So I'll say statement of cash flows for the year ended 31st December 2021. So let me fix my currency signs here and there. So just like I taught you, it's under 3 headings: operating activities, investing activities, and financing activities. So we are going to begin with cash flows from operating activities. And then under that, we are going to start with the operating profit. The operating profit is the net profit before interest and tax. And in this question, it's 32,500. So that is what we are going to start with, begin with. 32,500. And then we know that we add back all non-cash items that were adjusted in the profit calculation up to that operating profit. And in this question, there is no profit or loss on sale of PPE. The only non-cash item here is the depreciation, and we calculated for depreciation from the workings. So we add back depreciation, and depreciation was from working 3. So the depreciation figure was 4,500 from the workings that we did, and that is going to give us 37,000. Okay, so now that we have added back the non-cash item, the next thing to do is to do your working capital changes. And so we are going to look at the working capital changes. And I have told you, when it comes to the working capital changes, we are focused on 3 main things: the trade receivables, the inventory, and then the trade payables. And looking at the inventory from the question at the beginning, we had inventory of 19,500 for 2020, and then for 2021 was 10,000, meaning that there has been a reduction, a decrease in inventory. And when there is a decrease in inventory, it means it is a cash inflow. It means that you have sold it for cash. That is the meaning. So the difference is 9,500. So you say decrease in inventories. It is important that you show workings. So you can open a bracket and say 19,500 minus 10,000, so that the examiner will know where you are coming from. So we add that to the profit after adjusting the non-cash items. And then we look at the accounts receivables. Now with the trade receivables, we did a working for that as a working for, where we adjusted the interest income receivable. And so we got the difference to be 6,300. So we have already done that. And that 6,300 was an increase in inventory and an increase, receivables. And an increase in trade receivable will come as an outflow. Increase in trade receivable. Because we have already done workings for that, I can just say working for the examiner to go and look at that. That is 6,300, and it's coming into brackets because it is a cash outflow. I'm sure this one is very understandable. And then finally, we look at the trade payables. The trade payables, opening balance for trade payables is 18,900, and then the closing balance for trade payable is 2,500. That is a very huge difference, and it's a decrease of 16,400. And ladies and gentlemen, when you are decreasing, your trade payables are decreasing, it means you have paid them. At the beginning you were owing 18,009. At the end of the period you are owing 2,005. So you have paid the difference, and the difference is 16,400, which will come as an outflow. So that is a decrease in trade payables. And you can open a bracket and show 18,900 minus 2,500, 16,400. And so when we are done with the working capital changes, we can just find the new figure for the cash profit under operating activities. Okay, so it's going to be 37,000 plus 9,005 minus 6,300 minus 16,400, and that is going to give us 23,800. Before we can now think of tax paid, dividend paid, and then interest paid. These are the three that is coming. The paid, not the received. And I have told you, when it comes to the dividend paid, we can decide to either treat it as an operating activity or we take it as a financing activity. Whichever one that you want will be acceptable. And so the tax paid and the dividend paid, there is also some workings that we have to do over there, but I wanted us to get here before we talk about that. Okay, so let us look at that. Now, remember that the tax that you have been given in the comprehensive income statement is only the tax incurred. If there were no opening liabilities and closing liability, or there are no liabilities concerning that in the statement of financial position, then you can say that we have paid all that tax. So that means that in that case, the tax incurred will be equal to the tax paid. But the moment there are liabilities, you need to do workings for tax. And that is exactly what I'm going to do with you now. Okay, so that will be working 6. We are going to work for tax payable, tax paid. We are also going to work for interest paid, and we are also going to work for dividend paid, if any. So let us look at the tax. In the current liabilities, there is income tax payable, and there is also interest payables. Once there are liabilities to that effect, you need to do workings. Now, let me just use the T format to make it very simple for you. So let us do that of the interest first. So let's say interest account. Now, the interest payable in the statement of financial position is a liability. Okay, and we know that the interest payable account is a liability account, and so it has a credit balance. So the opening balance for interest in this question is 1,000. That is the interest payable. Let me just bring the payable here. Now, the opening balance for interest payable is 1,000. So it means it's a credit balance. Balance brought down is 1,000, or balance brought forward. And the closing balance is 2,300. So we have a balance carried down of 2,300. So whenever you are doing workings for interest payable, tax payable, dividend payable, after your working capital changes, when you get here, it's the same format for all the three, for tax, interest, and dividend. Your opening liability, your closing liability, and then you look for the interest expense incurred in the statement of profit or loss. So when we go to the statement of profit or loss, we have an interest expense of 4,000. If you can see that, interest expense of 4,000. And that interest expense of 4,000 will be credited to the interest payable account because it's an expense, so it's adding up. So you come and you see income statement or profit or loss, 4,000. So you are adding up to your opening liability. Then you can close it. So let's assume that you started the year owing 1,000. You have increased your expense by 4,000. So that gives you 5,000, and that should be the total for the two. So this is what you always do. Your opening liability, your closing liability as a carry down, then the expense for the year comes to the credit side to add up because it has a credit balance. And then the difference is 2,700. This difference is actually the cash that has been paid for the interest within the year because you started the year owing 1,000 Ghana cedis for interest. You also incurred interest expense of 4,000. That means that your closing balance for interest should have been 5,000. But we are saying your closing balance is 2,003. How is it possible? It means you have paid some. If you are supposed to pay 5,000 and you have paid 2,003, and you are owing 2,003 at the end, then it means you have paid the difference, which is 2,007. And this cash that we have paid is what we actually need as interest paid on the statement of cash flows. It could have been presented in a different way. You could have presented it this way, that interest payable. For those of you who are not very conversant with the T format, you could have presented it this way, that the balance brought forward is 1,000. And then you add the interest expense for the year. That would have been 4,000 to give you 5,000, just as I was explaining. And then you can less the balance carried down, or the closing balance, which is 2,300. And when you take that out, it's going to give you 2,700. And this 2,700 will be called cash paid for interest. So whether you are going by this way or that way, your answer should be the same. So I just want you to understand that the interest you see on the statement of profit or loss is not the interest you are going to bring into the cash flow. So you should be careful. Okay, because in this question, the interest is 4,000 in the statement of profit or loss. But when we did the working, we are getting 2,007. So assuming you pick the 4,000 as interest paid, that would have given you a wrong answer. So that is it. And we are going to use the same approach to find the tax as well. So let's also look at tax payable for the year. So tax payable. Now, the same approach. Tax is also a liability. So it's also having a credit balance. So look at your liability account. Now, don't get me wrong. If there is no liabilities for tax, you don't do these workings. If there is no liabilities for interest, you don't do these workings. In that case, the one in the profit or loss will be the same as the one paid. Okay? Assuming that this place was zero, there was no opening liability, and there is no closing liability, there is zero, and there is only the 4,000 here, then it means the difference will still be 4,000. That is what has been paid. So that is the meaning. So let's look at the tax payable. What is the opening liability for income tax? That is 10,000. So we have a balance brought forward of 10,000 as an opening liability for tax. And then the closing liability for tax is 4,000. So the balance carried down is 4,000. And then let's look at the tax expense for the year. Going through the question, the tax expense for the year is 3,000. That is the taxation in the statement of income. So we bring that here as profit or loss. That is 3,000. So it means that you were owing 10,000 at the beginning. You have incurred 3,000 more. That should have made you owe 13,000 at the end. So if you are not owing 13,000, you are owing only 4,000. Then the difference of 9,000 is cash paid for tax. So that is what we are going to use as our tax paid in the statement of cash flows. Okay. Then let us also look at the dividend. Let us decide to treat dividend under operating activity, dividend paid. Now, there is no liability for dividend paid or dividend payable in the statement of financial position. So what is going to happen is that the dividend incurred, which is now dividend expense, will not be found in the income statement. It will be found in the income surplus account. So we have 12,000 for dividend. So what should have happened is that we should have gotten an opening balance for dividend payable like this, just like we did for the other two. Sorry. Just like we did for the other two. So we should have gotten a balance brought forward for dividend and then a balance carried down for dividend. Now in this question is zero, and it's zero for carried down because there is nothing. I'm just using this to explain some principle to you. So dividend payable. So the dividend incurred from the income surplus is 12,000. So if you close off the account, you are going to still have 12,000 here, and the difference will be 12,000. That will be the cash paid. So in other words, because there are no liabilities at the end or at the opening, the dividend incurred is the same as the dividend paid. So there may be no need even for these workings. So what I'm trying to tell you is that anytime you have no liability for interest, tax, or dividend, please just take the figure there and then use it straight as paid. But whenever there is a liability, then you try to do these workings in order to ascertain the actual amount that has been paid for tax, interest, or dividend. So we are going to transfer them onto the statement of cash flows that we are doing. Okay. When we come to the statement of cash flows, we will see interest paid. We are interested in only the cash components. So interest paid is 2,700. It's an outflow. So I put it in brackets. Then we will say tax paid. Tax paid is 9,000 from our workings. So interest paid is working 6. Tax paid is working 7. And then dividend. Dividend paid is 12,000. We picked it directly from the question. They are all in brackets. So we are now supposed to be done with the operating activities. Okay. We are supposed to be done with the cash flows from operating activities at this point. But then there was an extraordinary item in this question that I didn't talk about in the format. Now let's go back to the question and look at something. After the net profits, we have net profit before tax, taxation, and the net profit on ordinary activities after tax, 30,500. There is an extraordinary item, and which is explained as net insurance proceeds from flood disaster settlement, 1,800. Now take note, these are proceeds. It's a cash inflow from disaster settlement of our flood. It's like you have insured your warehouse, there was a flood that destroyed a part of your inventories, and then insurance company is paying you money as a claim for those lost assets that were insured. So because the inventories were in the warehouse and they were supposed to be part of operations, we sell them to generate cash, and it has been destroyed by a flood, and the insurance company is paying us for that. We still treat that receipt as an operating activity. We cannot take it as an investing activity because it doesn't relate to a non-current asset, and we cannot also take it as a financing activity. So those proceeds that are coming from insurance should be treated as operating activity. So we'll say that proceeds from flood disaster settlement. It is not a usual thing in statement of cash flows, but when it comes, you should know how to treat it. And that is 1,800 Ghana cedis. And so now we are done with operating activities. And so we can add up and see. So 23,800 minus 2,700 minus 9,000 minus 12,000 plus 1,800 is going to give us 1,900 Ghana cedis. That is what we are going to have as the net cash flows for operating activities. So we call it net cash flows from operating activities. And look at where I recorded that. I pushed that to the extreme right. That is under the last currency sign. Okay, so having done with the cash flows from operating activities, the next is the cash flows from investing activities. So I'm just going to skip that and continue from this side. So I'm cleaning these workings as well. So we have cash flows from investing activities. And over here, I told you that the most important aspect here are the non-current assets. It's either it's a purchase of non-current asset or a sale from non-current asset, the proceeds, or investment income that is coming from the purchase of a non-current asset or shares. And so over here, we have already calculated for our purchase of PPE from our initial workings, working 2. So we have purchase of PPE to be 10,000, and it's an outflow. Okay, and then we have proceeds from the sale of PPE. We sold PPE and we had 200. That one is an inflow, if you could remember that. And then also there was investment income, which was made up of interest income and then dividend income. So interest income was supposed to be 3,000 as incurred, but remember that there was 1,000 which was still receivable. So we had only received 2,000. So that is an inflow. Investment income received. We are only interested in what we have received. Okay, investment income received. And then there was also dividend income received of 2,000. All right, so these are the cash flows from investing activities as far as this question is concerned. Yeah, and when we add that up, that is going to give us a total of, we have 10,000 as a negative figure, and then we have 4,002 as a positive. So the difference is going to be 5,800 in bracket. It will be a net negative. So we are going to have net cash flows from investing activities as a negative figure. Net cash flows from investing activities. So we are done. So when it comes to, I always tell you that the major work is with the operating activities. However, the most technical of them is with the investing activities. How to find your purchase of a PPE and all that. This is from working 2. Okay. And then I think these ones were from working 6. Okay. So that is it for investing activity. We don't have much information there, but it's very technical. So we need to pay attention to that. And then finally, we look at our cash flows from financing activities. When it comes to cash flows from financing activities, I told you that we are interested in the items under the finance by, which is the equity and the long-term debt. So let's go there and find out if there is an increase in the share capital, that is a proceeds from issue of shares. If there is an increase in your long-term loan, it means you have gone in for more loan. If there is a decrease, it means you have paid your loan. That is the dynamics of the financing activities. And then after the two, I'll draw attention to one more important thing, and then we'll be done with this question. So let us go back to the question and look at something. Now, under the equity, we could see that the share capital at the beginning is 12,500, and the share capital at the end is 15,000. There could be only one explanation: issue of shares, obviously. So we'll say proceeds from the issue of shares. At the beginning, we had the share to be 12,500. It has increased to 15,000. So 15,000 minus 12,500. That is going to give us 2,500 as the increase in the stated capital, which is resulting from proceeds from the issue of shares. So it's a cash inflow. That is why I've left it positive. And then let us also look at the loan capital. We are told that under the long-term liabilities, we have two major things: the long-term debt and then the finance lease obligation. So the long-term debt at the beginning was 10,400. At the end, it's 4,900. So it could be this is just an increase which shows we have gone in for more loans, just like we interpret the working capital items. So you started the year, so loan proceeds. Okay, it's a cash inflow. You started the year with 10,400 Ghana cedis as your loan balance. Then you are ending the year as 14,900. So you have gone for extra loan. If you subtract, the difference is 4,500. And that is an inflow of cash. You have gone in for more loan. And then look at the finance lease obligation. There was no opening balance, yes. But at the end, it's 8,100. Let us pause to think. From our calculations, we realize, and from the question, we realize that the finance lease that we went for the assets, the lease is like a liability to you. So you have gone to lease an asset for 9,000. But at the end of the period, instead of showing all the 9,000 as your long-term liability, you have shown 8,100. There is a difference of 900. Where has it gone to? In terms of the indirect method of cash flow, we say you have paid your debt. 900 has been paid, because with a lease, there is always an annual payment that is made to the lessor. So what we have done is that the 9,000 is actually the lease amount, but we have shown only 8,100 as a liability, meaning that is how much we are owing. So if you have gone to lease an asset for 9,000 and you confidently say in your financial statement that you owe 8,001, then you have paid 900. So that 900 is a cash outflow. So you say that payment for lease, and that will be the 9,000 minus 8,100, showing an outflow of 900 cash. So that is going to be in brackets because it is a cash outflow, and that will be all for the financing activity. There is nothing more under equity and the long-term debt, and there is nothing more said about financing activity in the additional information. So let us add that up. 2,005 plus 4,005 is 7,000, minus 900 will give us 6,100 positive, and that is our net cash flows from financing activities. Net cash flows from financing activities. Gentlemen, so soon we have come to the end of the statement of cash flows. So what we are going to do now is to add up the net cash flows from all the three activities. Cash flows from the operating activities 1,009 positive, investing is 5,008 negative, and then financing is 6,001 positive. So we are going to add the three to get our net increase or decrease in cash and cash equivalents. And that is what we established at the beginning to be 2,200 from the question. And so 6,001 minus is this positive minus this plus that. So 6,1 minus that is going to give us 300. 300 plus 1,009 is going to give us 2,200 positive. And this is exactly what we had from the beginning when we did the working one. So if you finish and you don't get a 2,200, then there is something wrong somewhere. So this is called our net increase. Remember, I told you you don't repeat increase or decrease when you know it's an increase. So it's a net increase in cash and cash equivalent for the year. Net increase in cash and cash equivalents. So now, having been able to establish your net increase, then you add your opening balance to get a closing balance. So you see cash and cash equivalents at the beginning. Now, going through the question, cash and cash equivalents at the beginning is 1,600, just as we got from the beginning, 1,600. And so when we add 1,600 to 2,200, we have 3,800. 3,008, which is also the cash and cash equivalent at the end. $3,800. Ladies and gentlemen, this is our closing cash balance, and this is our net increase or decrease in cash and cash equivalents. Yeah, so this brings us to the end of the part 2 of our lesson on statement of cash flows. But we are not actually done entirely, but at least we have done quite a lot. What we have to do is that there are requests for other topics which I'm here to treat. So I'm going to still focus on some other topics to treat, but very soon I'm going to solve another question on cash flows, which is more complex and more advanced than what I have done now. And then in the future, when I start with the consolidation, I'm going to also treat not only the consolidated statement of financial position and then the comprehensive income, but I'm also going to talk about the consolidated statement of cash flows, which is going to help us build our capacity as accountants and as finance experts. But until we meet again another time for another lesson, I want you to subscribe to this channel. Please share this video. Don't just come and watch and go. There are a lot of you who just come, watch and go, and then you don't subscribe to the channel. You don't recommend to anyone. Please, if you have been blessed by this video, just share, let others have a benefit, become an ambassador to the channel. Okay, let us all learn together and be successful together. And until we meet again another time, it is bye for now.